Hello everyone, welcome to our discussion of chapter 17, which is really just an extension of what we learned in chapter 16. Just some more detail on some things that make it a little bit different. So we kind of left off in chapter 16 with the idea that we actually can use journal entries to record the standard costs and variances. And if you do that, if you are using those accounts to calculate to record variances, then at the end of the accounting period, usually at the end of the year, you're going to have to make your variances zero because they really aren't assets or liability or expense accounts. They are just kind of a holding account during the year. So at the end of the year, we're going to close a meeting. We're going to, if there's a debit balance, we're going to credit it. If there's a credit balance, we're going to debit it. And then do the opposite to cost of goods sold. So if you look at our example from chapter 16, okay, where we had our variances analysis, remember, we figured out the detail of this manufacturing variances and so forth. Then, based on that, okay, our unfavorable manufacturing cost variance, lumping them all together at 90,000 units, 28,890, and then our fixed manufacturing costs were favorable by 4,500, right? So the journal entry to get those to the right place in the cost of goods sold, okay, is to debit cost of goods sold 24,390 and debit fixed overhead price variance because it's a favorable variance. So it's favorable variances would be credits. So we would debit that. We would credit the variable production cost variance because that would be a debit because it was unfavorable, and the difference goes to cost of goods sold. That's what we mean by closing production cost variances to cost of goods sold. Now, we probably wouldn't, and we haven't talked about variances with regard to sales and administrative costs. None of those would be closed, any variances there. And I don't think companies use actual accounts for any variances for anything other than production costs. So direct materials, direct labor, variable overhead, fixed overhead, that's commonly used standard costs to actually make the journal entries. But because it actually makes things simpler in that you know what your journal entries are going to be in terms of the amounts based on production ahead of time, or it's easy to figure them out. You don't have to look up the actual cost that you paid for a particular material because you know what the standard is. And so you don't have to look it up when it's time to make a journal entry. You can figure out the amount of your journal entry without looking that up. Okay, so now we, in chapter 16, assumed that when we bought materials, we bought and used the same amount. Okay, so here in chapter 17, we're going to look at the possibility that we keep inventory on hand, meaning we buy raw materials and we keep it in a warehouse and we utilize it as we go along, but we may not buy and use the same amount. So we need to do the price variance on our materials separate from our efficiency variance or usage variance because we're dealing with different amounts. All right, so that's not a problem with variable overhead, not a problem with direct labor because you can't store either of those two. So it's only materials that direct materials that this comes up with, okay? So we have our same information that we from our assumption in chapter 16. 4 pounds per case, 55 cents per pound, $2.20 per case. We produced 80,000 cases in August, okay? And we have actual materials purchased and used, 328, 60 cents, at 60 cents, okay? Remember the variances were calculated, okay? So here we're purchased and used the same amount. This is a repeat of what we did earlier. And you see in chapter 16. Now, let's break it into the situation that instead of buying 328,000 pounds, we bought 350,000 pounds. So we bought a little extra, okay? And we didn't use it all. We still used the amount that, the 328 that we talked about in chapter 16. So we first calculate the price variance based on what we bought. So we know that there are 60 cents and we bought 350,000 pounds in this scenario, okay? And we compare that to the price of 350,000 pounds. So it doesn't make sense to compare the price with, what we use because that's not what we bought. So we calculate the price variance based on what we buy, because even though it's different than what we used. So our price variance is unfavorable, right? Because we bought it for 60 cents and we should have bought it for 55 cents. And we multiply that difference, if you're using the formula, times 350,000 pounds. That's what's different in this scenario. We're actually buying 350,000 pounds. Now, our efficiency variance is going to be the same as it was previously, because we used 328 and we should have used 320. So we still have that same 8,000 pound difference in what we use, because that's independent of what we bought. Okay, so we still have the 4,400 unfavorable, but we also have this price variance unfavorable, but it's not based on the 328 that we used. It's based on 350,000 that we bought. And so what's going to happen to the other 22,000? They're going to be added to inventory. So we'll have more inventory at the end of the accounting period than we did at the beginning of the accounting period, if we buy more than we use. And it wouldn't matter if we bought more or less, okay, but we'd obviously have to have stuff in inventory already if we're going to buy less than we use, right? You can't use more than you bought unless you have some sitting around left over from the month before. So, using the standard costs, I promised that we would show you some journal entries about how to record what we're doing if we use standard costs in our actual journal entry, in our actual T accounts. Okay, so we're buying 350,000 pounds at 60 cents, right? So you have to record accounts payable 210 because that's what you need to pay your supplier. But we should have paid only 55 cents. So the materials inventory that we're going to debit into inventory is 350,000 times 55 cents. That's 192,500. The difference of 5 cents per pound times 350,000 pounds is the materials price variance. And so we actually have an account called materials price variance. That's going to get a debit. So our journal entry still balances, even though the amount that we actually are going to pay versus what we're actually going to put in inventory, they don't match. The difference is the variance. Okay? Then when we use it into work in process, when we move our raw materials into work in process, we're going to credit materials inventory for the 328. okay, of materials at 55 cents. So now that we're at 55 cents, everything goes at 55 cents. 180,400. But what we're actually going to put into work in process inventory is the 320 times 55 cents. The number of pounds we should have used. Okay, so you might say that this materials efficiency variance is waste, right? Because we should have used 320. We actually used 328. Okay, so this materials efficiency variance is a debit, like an expense. Okay, unfavorable variance. We used more material, wasted it, whatever, than we should have. And those same kind of principles go to direct labor and variable overhead. All right. Now, to introduce a couple of variances that actually are looking at our marketing performance. Okay. So, our sales were different than what we planned. Okay, in our budget. And the question is that a general problem? Meaning, is the industry as a whole, were their sales down? Or did we get beat out? Did we have a smaller market share? When we talk about market share, we're talking about what percentage of the total sales. So if we're selling toothpaste, okay, if all of toothpaste was down for the year or for the month or whatever time period we're looking at, if all toothpaste sales were off, okay, because maybe there's been an entirely new approach to cleaning teeth that reuses less toothpaste, then we would expect our sales to go down as well. And there wouldn't be much we could do about that, okay? But if sales were basically the same for all toothpaste, but competitors were able to get people to buy their toothpaste instead of ours, our market share, our percentage of the total toothpaste sales would shrink. Okay, and then we'd have a market share variance. All right, so that's the difference between these two variances, and they both add up to our total sales variance, right? So our sales volume was 20,000 fewer cases. All right, our industry volume, the industry was up. So our total for the rest of, for all of the industry we operate in, okay, we should have been up 25,000 additional cases. Okay? But we had our market share, we went from a 25% down to 16%. That's 45,000 fewer cases. So of the total things sold, we got beat out. We had less. Okay? So how did that affect our profitability? Okay? So our industry volume variance had a favorable, meaning the industry as a whole grew, okay, and our costs are $4.70, our sales price is $10, so each one has a contribution margin of $5.30. That we should have been able to have 25,000 more sales because of overall growth in the market. But because we got beat out and because our part of the pie shrank, even though the pie was growing, okay, that cost us $238,000. So together, that's the $106,000 unfavorable profit variance that we had way back in chapter 16. Okay, so that's two ways to look at how we did on sales. What caused our activity of the amount of cases we sold to be lower? Was it because of the industry as a whole being lower, or was it because we got beat out? And clearly the answer here is we got beat out in this situation, and therefore we have some very serious ability to look at what we need to do to reverse that trend. All right, so another way to look at marketing performance, our ability to sell our product, is two other variances. One, the sales mix, okay, and the sales quantity. So sales quantity really is back to what we've talked about earlier. We sold less cases than we planned on, okay? So that's the sales quantity variance. That can be because of, like we talked about earlier, either the industry is changing or we're getting beat out as far as by our competitors. What we have some more control over or haven't looked at is the sales mix variance, meaning typically we sell a certain percentage of different products. So if we have multiple products, we might sell 20% of A, 40% of B, and 40% of C. Okay, so that's our mix. We normally sell or plan on selling 20%, 40%, 40%. Well, difference, if that changes and we sell 20%, 50%, and 30%, and I'll have to add up to 100%, right? Then that's going to change our profitability based on the profitability of each of those products. So that's a sales mix variance. That's a difference from what we plan in terms of our sales mix. Now, that usually becomes a problem if we're selling more products that make us less money, have a lower contribution margin. Okay? And less products that make more money or have a higher contribution margin than we planned. That would be an unfavorable variance. That would hurt our profitability because we're selling less of the high profit items. So, for example, if you are McDonald's and you're selling, let's say, Big Macs and Big Mac meals, okay? So Big Mac meals have fries and a drink, which have a much higher profit margin, lower cost, than the Big Mac itself compared to the price, a higher contribution margin. So a Big Mac meal is preferable because it has a higher contribution margin. And Big Mac themselves make a lower contribution margin. So maybe our goal is to sell 20% Big Macs and 80% Big Mac meals. Okay, we want to, or our budget or our goal is to be that sales mix. Well, maybe people, because of whatever reason, our French fries aren't as good, maybe they're being more health conscious and they look at health as French fries as being a poor choice even compared to the hamburger. And so our customers are buying a larger percentage of just the Big Mac alone. Sales as a whole are about the same, hasn't changed much. Number of customers come in, but instead of ordering a whole meal, they're ordering just the sandwich. All right? That's going to change our profitability. All right? And that's a sales mix variance. It's different from what we planned. So, example with industrial and standard products here. Okay? So we have a standard contribution margin for the industrial of $7. Standard is going to make us $3. And we focus on that contribution margin. What we plan on is to sell 20% industrial, 80% standard. But what actually happened, okay, is we sold 23% and 77%. Okay? So that means our sales quantity is higher for industrial than we planned. Okay? Okay. Our overall sales total was down, but our percentage was higher. Okay? So the amount that we would have sold in our revenue at the budgeted sales mix and budgeted sales quantity, 50,000, 10,000 industrial, 40,000 standard, it would get you 70,000 and 120,000 contribution margin, so a total 190,000 contribution margin. But our actual sales quantity was 9,200 and 30,800. Notice our total sales in units was down by 10,000. So contribution margin, go back there, is 64,000 and 92,000 for a total of 156. All right? And so you see the calculations down here. So we had a contribution margin 156 rather than 190, which was our budget. Unfavorable variance of 33,200. Now, that's the total budget difference between what we budgeted for sales and what our, as far as contribution margin, and what actually happened. So let's break that down a little bit, okay, into our mix and quantity variance. Sales mix variable. So we have our flexible budget, and notice we do it twice. We do it the industrial, the standard, and then we can do the total if we so choose. So the flexible budget is at the 9,200 that actually happened. So we plan on making $7, and okay, the actual sales was 9,200. Actual sales was 30,800, and we make $3. What we planned on, okay, was if we had actually sold 40,000 units, we would have planned on making 23% of that, 20% of those for the industrial, and that would have been 56,000. So because we said 23 instead of 20%, we actually had a favorable mix variance of 8,400. In this case, for the standard, okay, we planned, if we were going to sell 40,000, we planned to sell 80% of those, all right, to be standard, and that would have made us $3. That would have been 96,000. So yes, we make less money on the standard, but together we have a favorable mix variance. Why? Because we sold more or a higher percentage of the more profitable product than we did than we planned. Okay, now the real plan, or the original plan, master budget, was to sell 50,000. So we should have sold 20% of 50,000, or 10,000 times 7, 70,000, and 40,000, which is 80% of 50,000 times 3, 120. So we should have had 190. So we were definitely unfavorable on the quantity variance, because why? We sold 40,000 and we were planning on selling 50,000 total. Okay? So we had a unfavorable because we had sales down, but we had a favorable because we sold more, or a higher percentage than we planned, of the more profitable units. Now this same idea, okay, can be applied to our production costs. All right? Whether it be materials or labor, all right, if we can utilize various materials to substitute for others or various labor costs. Probably most likely in the labor area. Because what happens when we get busy in production is we may bring people in that to help out, and they may have a higher price or labor rate than what we planned. So we planned on using 3 people that make $20 an hour and 1 person that makes $40 an hour as a team. Okay? But because of staffing issues or whatever, we end up using 2 people that make $20 an hour and 2 people that make $40 an hour. We're going to have an unfavorable variance because our costs are going to be higher than we planned. And the reason why is because our mix of people is different than what we anticipate. Okay? But the same thing applies to materials. If you can substitute materials, an expensive material for an inexpensive or vice versa, if they can be substituted in, then one for the other, and it's not doesn't have to be exact, then it can also apply to higher price or low price materials. So here's one that applies, okay, to materials. We have 2 direct materials, C and D for short. Okay, one costs $5, one costs $15. So we make a pretty big difference in the cost, so you can see the illustration. Okay, and the way that we should mix them is 60-40. All right, so we should have 60% at $5 or 0.6 of a gallon if we're going to make 1 gallon. Okay, that would cost $3 of C and $6 of D for a total of $9. So before, when we were dealing with direct material variances, we were only dealing with 1 material, right, at a time. This is a situation where we're actually putting 2 materials at a time into a process, and therefore we could have different than this 60-40 split. Okay? So we're going to make 100,000. So we would expect to do 60% C and 40% D. But what actually happened, all right, is that we use 55 of C and 49 of D. So we're going to have a variance. We're going to have a variance, first of all, because we would expect to use 100,000 in total, okay, but we actually used 104. That's the yield variance. That means that somehow 4,000 gallons disappeared, evaporated, spilled, wasted, had to be rejected for whatever, something like that. So that's the yield variance. So it didn't yield what we thought it was going to. And then we have this situation where we didn't use the proper mix, or maybe it's not that it wasn't proper, there's some discretion in the mix, and we use a different mix than what we plan to use. Okay? So what we should have done is 60% of 104 would be C, or 62,400 gallons, or 40% of D of the total 104,000 that we used. Okay, 41,600, okay, of D. Some preliminary calculations. So here's how we might work this out. Now notice the purchase price variance, okay, is separate and done the way it was previously, and we are purchasing and using the same amount. So we're focused on this efficiency variance, and we're breaking it into 2 pieces, the mix variance and the yield variance. The mix variance is because we use a different mix, okay? So we should have used 55,000, okay? Or we did use 55,000 and 49,000, okay? So we can multiply that out using the standard price of $5 and $15. Now, if we use 104 and did the standard mix, that would be 60%. So 104,000 times 0.6 or 60% times the $5. And 104,000, so now we have increased the amount from, okay, what we, using the actual amount of gallons used, but we're using the standard mix of 48 and 60. Okay, and then multiplying it by the standard price. So we have a favorable mix variance here, okay, because we used less than what we would normally use. We use 55, which is clearly less than 60% of 104. And here we use more, right? We still had to have more, we had to get gallons there, okay? So there's going to be unfavorable. So you're going, if there's a difference, it's going to be, right, one's going to offset the other, at least to some extent. Now, in this case, because we use more of the more expensive product, this is overall an unfavorable variance, right? Because by shifting and using more of the $15 input rather than the $5 input, we're actually costing a lot more money to the term of 74,000. Now, the yield variance, okay, is going to be the same for both, same direction. All right? So what should have happened is we should have used 100,000 total, and that would have been 60% C, or 60,000, and it cost us $5 or 300,000, and 40,000 for D, costs $15 or 600,000, total 900,000. But because we used an extra 4,000, all right, that cost us 36,000. That's unfavorable, right? That extra 4,000, 60% of them C at $5, 40% of them at 15, okay, cost us extra 24,000. So that's just overall being sloppy in terms of how much total materials we used in our production. So there's kind of broken down a little different way to see it, okay? Maybe summarize, you might say, if that helps picture the differences and what caused them. And then the journal entries, using now the price variance, yield variance, the mix variance, okay, and separating the two different products, okay. So again, the actual amount purchased would be credit to accounts payable, and the standard, what we would have expected to make 90,000 or whatever the production is, okay, in work in process. And then all of the variances, either credited if it's a favorable variance, debit if it's an unfavorable variance. Now, do companies that don't manufacture use variance analysis? Sure, absolutely. You can look at what it should cost you for any kind of service, whether it be rooms or airlines or days in the hospital, any of those things, to measure and then compare to what your budget is, what your actual, and see the variance. In fact, done all the time, maybe even a little simpler because you typically don't have direct materials to worry about. Okay. Now, why do we calculate all these variances other than making journal entries and things like that? the concept is management by exception. If things are running the way we planned, then we probably don't need to go meddle with it or figure out what's happening. It's happening the way we planned, and that's good. And we can divert our attention to other things, setting new goals, that sort of thing. But when there is exception, that's where we're going to spend our time. The idea is to identify those things to investigate by looking for variances. And generally what you're going to do is base it on some percentage of the total cost. So variances that might be more than 5%. And we would look at favorable and unfavorable, because remember we talked about that earlier. And decided that even favorable variances can be an issue down the road if we are short, cutting corners on things and not spending the money that we should. All right, so identifying variances then gives us where to investigate, where to spend our time as a manager, because there's always more things to do than we can get to. Okay. When deciding which ones to look into, maybe it's not just amount, we also might look at whether it's in control of the manager. Okay, is there something we can look at? If we are the production manager and the sales variances aren't going to be of interest, we don't control those. We don't have any much of a say in that. We are more looking at yield variances, purchase price variances, that sort of thing, in terms of our materials. And by separating into smaller pieces, we can hopefully identify, did we buy cheaper material to get a favorable price variance, and that end up being, we have to use more, so therefore it was an unfavorable efficiency variance. Those are the kinds of questions we are constantly looking at, asking ourselves when we're using these variances.